SpaceX is worth $350 billion. That's more than Boeing, Lockheed Martin, and Northrop Grumman combined. Pause. And right now, it's in zero of your index funds. Zero. The most valuable aerospace company on the planet is completely invisible to passive investors, but that's about to change, and when it does, your portfolio will shift whether you're ready or not. Here's what I'm going to show you in the next 7 minutes, exactly how SpaceX's IPO will ripple through the S&P 500, total market funds, and sector ETFs, the specific rules that determine when it enters your funds, and the counterintuitive problem that most finance channels won't mention because it doesn't fit the hype narrative. Let's get into the mechanics. First, you need to understand how index inclusion actually works, because most investors have this completely backwards. They think IPO happens, stock enters index, done. Pause. Wrong. The S&P 500 has a committee, a literal group of humans at S&P Dow Jones Indices who vote on inclusion, and they have rules. The company needs 4 consecutive quarters of positive GAAP earnings. It needs sufficient float, meaning enough shares available for public trading, and it needs to meet market cap requirements, which SpaceX clears by a factor of 10. But here's the catch. SpaceX is currently not profitable by GAAP standards. Starlink is printing money, but the broader company reinvests aggressively. So even after IPO, S&P 500 inclusion is not guaranteed. It could take years. Pause. Tesla went public in 2010. It didn't enter the S&P 500 until December 2020. 10 years. Let that satisfying hat sink in. Now here's where it gets interesting for total market index fund holders. If you own VTI, ITOT, or SWTSX funds that track the total US stock market, you'll get SpaceX exposure much faster. These funds don't wait for committee approval. They track the CRSP US Total Market Index, or similar broad benchmarks that include companies shortly after IPO, sometimes within days of listing. So while S&P 500 investors wait for the profitability box to get checked, total market investors are already in. Pause. Stop for a second. This is actually a meaningful difference in how 2 of the most popular passive strategies will respond to the same event. And nobody talks about it, but let's address the elephant in the room. The thing that makes this less exciting than the headlines suggest. Dilution. When SpaceX enters an index, your fund doesn't just magically add free SpaceX shares, it has to buy them, which means it sells portions of everything else you already own. Your Apple position gets a little smaller, your Microsoft, your Nvidia, your Amazon, all trimmed to make room for the new addition. At $350 billion, SpaceX would enter somewhere around the 15th largest position in the S&P 500. That's not trivial. Every company currently in the top 20 gets diluted. Pause. You're not adding value to your portfolio, you're reallocating it. Now, does this mean you shouldn't care? Absolutely not. Here's the framework smart investors are using. Scenario 1, SpaceX continues dominating. Starlink hits profitability milestones, launch contracts multiply, and the stock rips after IPO. In this case, total market investors capture gains earlier. S&P 500 investors buy in later at higher prices, meaning their eventual reallocation costs more. Scenario 2, SpaceX trades sideways or drops post-IPO like many high-profile listings do. S&P 500 investors dodge early volatility. The profitability requirements act as a quality filter. Scenario 3, you want targeted exposure without waiting. Aerospace and defense. ETFs like ITA or XAR will likely add SpaceX faster than broad market indices. Higher concentration, higher risk, faster access. Pause. There's no universally right answer here, but there is a right question. What is your actual goal? If you're a true passive investor with a 30-year horizon, this changes almost nothing about your strategy. SpaceX will enter your funds eventually. You'll own it at whatever weight the market determines. Trying to time around IPOs is active investing wearing passive clothing. If you believe SpaceX is generationally undervalued and you want concentrated exposure, waiting for index inclusion defeats the purpose. You buy individual shares at IPO and accept the volatility, And if you're somewhere in between, maybe you tilt toward total market funds specifically to capture IPOs faster. This is validation that your strategy works as intended. Here's the bottom line. SpaceX's IPO will be the most watched listing since maybe Facebook. Financial media will treat it like the investing event of the decade, and for passive investors, it will matter, but probably less dramatically than the headlines suggest. Your index funds will adapt automatically. The question is whether you understand the timeline and the trade-offs. Now you do. If this breakdown helped you think more clearly about how your money actually works, subscribe. I release one video per week going deep on exactly these kinds of structural questions, the stuff that moves portfolios, not just prices. Hit subscribe, and I'll see you in the next one.